I'm Peter Boockvar, the Chief Investment Officer with Bleakley Advisory Group. This is our first quarterly video where we review the prior quarter and give a forecast on the next quarter. The first half of the year I'm going to take from Charles Dickens and saying it was a tale of two cities. It was the best of times, it was the worst of times. We saw outperformance in US markets, we saw major underperformance in basically everything else. Where the S&P 500 for the year is up about 1%, the MSCI Global Index ex-US is down about 5 to 6%. And we also saw some bifurcations with fixed income throughout the world. In the US, high yield outperforming investment grade. So positioning really was important. I think rising rates and the tariff issues are becoming more ingrained in psychology and really what is the main cause for the separations in these different markets. So the tariff spat that the US is now having with other countries is really the main macro story in the second quarter, as opposed to interest rates dominating the news flow in the first quarter. So we originally started with threats of tariffs in order to try to bring countries to the table, hopefully reducing tariffs across the board, but with particularly China to try to do a better job of them protecting US intellectual property. The problem now is that we're moving from the proposed tariff phase into actual implementation, with US tariffs on foreign countries and countries overseas now retaliating against the US, whether it's Canada, Mexico, the European Union, and China. And I think that is a main reason why international markets that are threatened by these tariffs have been more affected than US-based domiciled companies that are a bit more insulated. I do expect, though, this to continue to be a problem and an issue and an overhang as we go into the second half, but we also remain hopeful that these threats do come to a closure in the sense of negotiations between us and other countries that will eventually lower tariffs for everybody. First half GDP in the US should average at about 3%. The first quarter came in at about 2%. The second quarter we're expecting 3 to 4% when it finally gets reported. It'll be the best quarter we've seen in a while, helped out by lower taxes on the corporate level and the individual level, and a reduction in the pace of regulations. Also, there's been a lot of government spending, which is adding to the fiscal boost. Overseas economies, it's a different story. Europe in particular is going to have a good year. 2% is a good year for Europe, but that's down from the 2.5 to 2.7% rate that we saw last year. Asia also going to see good growth, but a slowdown, particularly led by China, which is still growing north of 6%. And we've seen a lot more turbulence in other emerging markets driven by the strengthening dollar. That's also going to be a little crimp on overseas growth. So overall, US is going to be the clear outperformer. Overseas growth is still good, but not as good as it was. First half of the year, the Fed raised interest rates fully as expected by 2 times. They will add a third one in September, matching the pace at which they did it last year. The question is whether they will raise in December, which I don't think they need to think about yet because it's still far off in the distance. Also, behind the scenes is the continued shrinking of their balance sheet. The second quarter of this year, the pace went up from $20 billion in Q1 to $30 billion, and in Q3 it goes up to $40 billion a month. By Q4, it's going to be $50 billion a month, which is an annualized rate of $600 billion. Also in the second half, the European Central Bank, which was purchasing assets at a pace at about 30 billion euros a month for the first 6 months of the year, they'll continue that into Q3, but ramp that down by half into Q4. So the net liquidity differential between the two central banks will begin to draw down in Q3. So that'll be a big liquidity differential in the second half of 2018 versus the first half of 2018. Earnings in the first quarter were up north of 2%, one of the best performances we've seen in years. About half of that was the cut in the corporate income tax rate, so that certainly was a big influence. But revenue growth was particularly strong, so even organic earnings growth and revenue growth was very good in the first quarter. I expect another good report in second quarter when we start to get earnings over the next month. The question, though, will be what is the guidance for the third quarter? Because if you're a big multinational company that is going to be impacted by tariffs, well, you're going to try to quantify that for investors in your guidance for the back half of this year. Going into 2018, one of my expectations was for higher inflation, and we've gotten that. In fact, the core PCE, which is the Fed's preferred inflation gauge as it takes out food and energy, is at 2%, which is a level they've been striving for a while, due to higher rents, medical care costs, transportation costs, commodity prices, and now we're seeing higher wages. The question is, do we sort of settle out at this 2% level, or do we continue to progress higher in the second half of the year? And I actually expect us to continue to trend higher, mostly because of the implementation of tariffs, which are now raising the cost of goods, which also means the Fed is going to continue to raise interest rates this year and also into 2019. So the macro factors that influence the first half of 2018, I expect to be the dominant factors in the second half of 2018. That is a continued rise in U.S. interest rates, a continued shrinkage of the Fed balance sheet, which is drawing liquidity out of the marketplace, and also the tariffs. Now, with respect to the Fed's balance sheet, we've never seen this before, so it makes it very difficult to gauge how the economy and how markets are going to handle it. But it's something that is a big focus of ours. In terms of the tariffs, it is a drag on growth, but we are hopeful that there will be some resolution very soon in this tariff spat so it doesn't further escalate. It does slow growth, it does raises the cost of goods, but again, it's hard to gauge how long this will last and how quickly we can negotiate away from this, and which would be good for global growth generally speaking. My June monthly should be out shortly. Go to Bleakley.com in order to get it, or reach out to your financial advisor and they can email it to you.